So I appreciate everybody joining us for the multifamily and hotel panel. Like I said, I'm Jeremy Christensen with Millennium Trust Company. Millennium Trust Company is an alternative asset custodian based in Chicago. We focus on holding alternative assets such as real estate, private equity, private debt, marketplace loans, and other alternative assets inside of individual accounts and then also inside of fund accounts as well. What I'm going to do with this panel is let everybody introduce themselves. Then we'll go through the questions, and I'm looking to leave about 10 minutes at the end for Q&A from the audience.
My name is Joseph DiMatteo from JDM Capital. I'm the President and Chief Executive Officer. Firm has been around for the last 15 years, heavily focused in hospitality over the increasing amount of the past 5. We have assets in, right now, currently in Florida. We're very active in the market down there with 4 projects in different various stages. And with our recent acquisition, been very busy down there and been spending at least 10 to 15 days a month there on an ongoing basis. We are also active within Texas, California, I would say Virginia up to Massachusetts and Chicago, and everything in between those areas. So we're actively looking for new projects. We're been working on principal activities for our own activity, and we've been working and advising for family offices and other funds on assets and investments that they may have sporadically or inspirationally taken on and need some additional assistance because of the complexity involved in surrounding hospitality investments. It's a envelope with a letter in it, as I like to say. It's a real estate asset with an operating business inside of it, which adds to its complexities and its various, rent roll that changes every night. So I'm happy to be here. Thank you, Michael, for inviting me to be able to speak, and happy to contribute any way we can.
Morning. I'm Chris Ennis, the founder and CIO of Dream America, a residential lease-to-own company. We're based in Miami. Our target markets are Florida, Georgia, and Tennessee. As I mentioned when Michael asked me if I was a Florida resident, recent transplant as of November. I spent 25 years on Wall Street at Salomon Brothers, Bank of America, and BNP Paribas, building and running derivatives and financing businesses. So you may wonder, how does a derivatives guy wind up in real estate? I've also been a developer and investor in residential and commercial real estate the past 20 years and decided to leave banking in 2017 and focus full-time on developing our business. We launched, to support that on the capital side, we launched a fund last year, the Dream America Fund. Since then, we've purchased 30 homes and had 6 of them sold back to our tenants. So our goal is to take somebody who wants to buy a house today, but for one reason or another cannot get their FHA or VA mortgage, put them into the house that they want to buy, and then give them a roadmap to become that homeowner over the course of a 1-year lease. And thanks, Reed Smith, for hosting us today, and Michael for inviting me to speak on the panel here with we got another panelist.
Good morning. My apologies. Traffic was worse than I expected.
Valley wasn't working?
You're up.
Yes.
Introduce yourself. Yeah.
Perfect timing. Good morning. Again, my apologies. Good morning. My apologies for being late. My name is Philip Silichanu. My background is in the fintech operations and FinReg side of the business for about 15 years. Went to law school, did FinReg, came back into the consulting side, and about a year ago or so, moved into the blockchain space and joined TokenIQ, that does security and asset tokenization.
All right, I appreciate that. I think we can forgive Philip. We started this thing about 30 minutes early, so I think we'll let that one go for sure. First question I have is for Chris. Can you kind of elaborate on the Dream America lease-to-own program, how that works, how somebody gets into a new house, how somebody goes from a renter to an owner?
Yeah, so as I started looking at the lease-to-own space, I felt that it was an interesting space from an investment opportunity, But frankly, what was missing in my mind was the value proposition for the tenant. So lease-to-own is not something I invented. It's obviously been around for a long time. It's historically been a mom-and-pop industry. However, there have been a number of institutional players that have come in the past decade, notably Home Partners, who's backed by KKR and Blackstone. They've done a few billion of deals. We've also more recently seen some fintechs come into the space. Bump into a group called Divvy Homes in Atlanta that's backed by Andreessen Horowitz. But in all of these companies, what I found was really an emphasis on the leasing. So you can lease and you've got an option to buy. But if you're dealing with a tenant who is in that situation because they were unable to get a mortgage today, how are they magically going to get it in a year or two from now? So in our program, we underwrite the same way that a lender would. We look at what is somebody's debt to income, what is that roadblock that keeps them from getting their FHA or VA mortgage today. Many of our clients are vets. And then once we have that in place, we make the client, the tenant, a part of that game plan. So everyone who comes into our program and picks the house that they want to ultimately buy, not only do they have an option to buy, they know what they need to do in order to get there. And that's really helped us, I think, as we've been ramping this up, start to stand out in the minds with realtors, which is ultimately how we get clients. Realtors are obviously trying to promote homeownership as well, and like this idea that we're not just sticking somebody in a lease to own, but we've actually got a game plan for them to come out the other side and be the owner of that house.
I got to think one of the really nice things about that is going to be ongoing. There's never going to be an end to something like that. People are always looking to own a home versus renting. With that being said, do you see more and more people looking to, it seems like we've had a bit of a trend go from home ownership to more renting over the last 10 years. Do you see that trend reversing? How do you see that going?
Yeah, I don't see the demand for this going away. So our focus is on the Southeast, but I spent a year before launching the fund just kind of working on the space, developing the idea and making sure that we had something that we thought worked. So I've also done deals in Texas, Arizona, and Nevada. So this is something, the demand for this exists nationwide, and it's not going away as long as there are FHA and VA mortgages, and I don't think that those are going to be disappearing anytime soon. So this is a space where there's ongoing demand. The thing that's interesting that I've learned about the FHA and VA space, obviously they're government-backed mortgage programs, which means the lender has no flexibility on the minimum requirements to get those mortgages. If somebody in this room, if you're wealthy and you want to buy a house in Florida, you go to First Republic or Gibraltar or one of many other banks, private banks that are out there, and they don't like, let's say, your debt to income, the chief loan officer could waive that requirement. There is no waiving of requirement with FHA and VA. So every lender that's doing that is doing the same thing. You either fit in that box or you don't fit in that box. And if you don't fit in that box, it can be very difficult for the average American to then figure out, what do I need to do to get that mortgage? And that's why the helping hand side of this, I think, is an important component in what we're doing.
Makes a lot of sense. Thank you. Philip, question for you. You're obviously right now dealing with a topic that's pretty hot as far as blockchain tokenization. Can you talk to us a little bit about where you're working on the real estate side with tokenization, kind of when you expect that to kind of advance to mainstream? Have you seen deals that have gone through so far that have worked out with tokenization?
Sure. Just to give you sort of a very sort of brief background on what Token IQ does. Basically, Token IQ takes private equity, private debt, real assets, and puts them on a token. A token is essentially a distributed ledger. You've heard the term distributed ledger technology, blockchain. At the end of the day, in the most simple terms, what you're doing with a token is essentially having a security instrument that's on an electronic format with all of the necessary and required information, everything from the cap table to record keeping, to any transaction history, to any regulatory terms. If you're looking at fixed income, you would have the fixed income terms, such as the coupon rate, the maturity, et cetera, all recorded securely, immutably, and easily shareable to the appropriate parties on an electronic transaction record. That's essentially a token. You're essentially taking what traditionally was kept on multiple different databases that had to be reconciled from one party to another on a regular basis and making it a shareable, one-of-a-kind copy that is accurate but distributable to multiple parties. So that's the basis of a token, really. Now, we've actually seen, to your point, quite a bit of interest in the real estate space, and actually there have been a few real estate deals that were done on the token. We actually did one of the first ones where there was a company called Oxygen Hospitality, which was doing a purchase and rehab of a resort out in Palm Springs, California, and they were doing a $10 million debt note to help finance the transaction. They came to us, and we helped them tokenize the transaction, and they were successfully subscribed within a few weeks for the full 10 million. So there is momentum out there, and we're getting quite a bit of inbound inquiries stemming from that initial deal that we did for Oxygen Hospitality. But in general, we're getting a lot of inbound leads from the real estate space because the ability to tokenize both the equity funding, the fixed income side, and the actual assets, the underlying assets in real estate, is really revolutionary. Without going into the weeds, really the biggest advantage for real estate to tokenize is the ability to fractionalize the ownership rights. Instead of having a $20 million building and you're trying to do a deal and trying to find maybe 10, 20 investors that each have $1 million, $2 million in capital that they can lock up for a number of years and not have to worry about exiting anytime soon. Now, by fractionalizing that deal through tokenization and the technology behind tokenization, you can have a buy-in for a property of 100,000, 50,000. And that opens up an entire new pool of capital that otherwise would be inaccessible through traditional means.
Thank you. Do you see this becoming very widespread in the real estate market? You know, kind of timing on that, when you think something like that might happen?
You know, one of the things that I learned in law school a while ago was just in the real estate law classes I took, and I was a member of the Florida Real Estate Attorneys Association. One of the things that you realize that the average layperson doesn't realize, but I'm sure that all, if not the majority of you here realize, is just how sort of archaic and, I hate to use this word, but old-fashioned the deed and rights recording system is. I mean, where I wrote an article a few months ago where I basically said, look, we're 1,000 years on from the Doomsday Book that recorded all the property in England, and we're essentially doing the same thing. We're recording, you know, the metes and bounds of a property and any rights and anything that conveys with the land. It's all being recorded in this sort of archaic book. And if you want to buy or sell a property, you have to go down to the local registrar and pull out a book and look at the page, et cetera. The industry is ripe for modernization, and we really believe that tokenization is the best way to do it because, again, being built on a token on the blockchain, that record, the entire provenance of a property from day one until today can easily be accessible. So do I think there's an opportunity? Absolutely. Do I think we're going to see a big move? Things move slowly. We're starting to see some deals on the token. I think it's more of a trickle effect right now. I think realistically we're going to see mainstream adoption of this technology in the next 2, 3 years beginning to really bubble up. And long term, I think, yes, I think eventually 10, 20 years from now, it'll be as common as an iPhone, as common as Uber.
Very nice. Question for Joseph. You talked a little bit about the states that you're in right now and the deals that you do. We talk a little bit about kind of the specifics of that. Are you looking at branded, non-branded type stuff? Has the environment changed any since Airbnb, some other co-share programs that are out there?
So we were pretty multifaceted from our side of our firm. We have dealt with both branded and non-branded. We're in the process of evolving our own brands right now that we're going to be utilizing on other projects as we expand. We see that it depends upon the geography. If you're in Manhattan, it doesn't matter if you're a franchise in a boutique. It depends upon the operator, the operations, the capitalization, the size of the transaction. We see that that's a versatile model and can be applied in certain locations. If you're in a tertiary part of Missouri and you're looking at an asset that's out there that you want to have a franchise system because you need the support of that reservation system beyond just the normal OTA channels that are dependent upon for us to be able to have the guests know that you exist and make sure that you're competitive enough to make sure we can match rate and build demand within that marketplace. So we're kind of really across the board from our own brands, our resort brand that we're rolling out now and we're building upon, and 2 boutique, 1 smaller, 1 larger scale boutique brand that is going to be underneath the JDM Capital Hospitality flag. We've worked with all the major chains, Marriott, Hilton, and some of the subsidiary, the ones that are below that, Choice and so forth. And we see that it's a marketplace decision, and the asset itself has to be able to be sustained in size. In that case, definitely dictates it. You don't want to have a 600, it's very hard to have a 600-key hotel that's living and breathing without the support of a reservation system. It's the wholesale markets and the international markets have changed. Your guest that you get that was maybe coming from South America, using Florida as an example, is not the same guest that you're getting today, that they've reduced their ability because of the strength of the dollar. Argentina is an example. We've seen a drop in South American activity from guests, and they're going to Europe. So without a brand to be able to support that draw and be able to communicate a message, it makes it a little bit more difficult. On the Airbnb, obviously really supportive of what New York has done. We like keeping them out. I think that, but as a concept, they're a marketing engine. So for them to be able to deliver safety, big issue. The quality of place that you're staying in is inconsistent. We see some issues with it, and that model itself is faulty, and that's our opportunity. We see opportunities in what they're missing and what they're not doing. For what their ultimate goal is to be able to make a transactional fee, our ultimate goal is the guest experience. We want to be synonymous in understanding what their needs are, our ability to be able to deliver a multi-sensory experience for them. And safety is a baseline for everybody. Right? You don't want to live in a neighborhood that you don't feel safe. You don't want to walk in a building that you don't feel safe. You don't want to have a place that you are unfamiliar with and no one's there to greet you and your toilet's clogged and no one can be able to fix it. So that's the professionalism of an operator like us and an asset manager that we function as to make sure the operations that we oversee are being able to guard that. And that has to have a full alignment of that, what the brand message is, what that sensory experience is, and how to deliver it on the most consistent basis.
And I assume like VRBO presents the same types of issues, same type of concerns on your side.
Yeah, I mean, if you start to look, their websites are even looking identical.
Right.
You know, it's they're a search engine. Google, as well. We all play in that, but the idea is that, they're a provider of competition in certain senses. They could be a provider of a guest night in this particular asset class that might be more longer-term stay or a condo resort structure that have different needs of that clientele. But the brands are wise to it. You've got Hilton, you've got Marriott, even with the merger of Starwood, which is, a brilliant way to capture market share and being the largest hotel company in the world, has an ability to deliver everything from the Ritz-Carlton to, your general hotel motel within that brand strategy. And that weakens the OTAs. And for those of you who don't mean that's online travel agency, I don't mean to use an acronym, but that was the Expedias of the world and so forth. They're building their own world that will eventually reduce the amount of dependency and increase their dependency as OTAs on boutique brands. So if you go and you look, you will see less and less franchises in certain markets being utilized as a vertical way to be able to capture guests, to be able to get them to come to your assets. So that change is already in evolution. They've been planning that for years brilliantly because they're sitting there and they know what their franchise fee model is. They know what they're trying to be able to get from a cash flow perspective. These OTAs, when they first came out, were, hey, listen, your travel agent charges you 10% for a commission. We're going to charge you 3 and 5%. Now they're charging 30% and you don't have travel agents anymore. So they created their own ability to, destroy a model. Unless you're, again, going at the high end, if you're, have these people who are delivering, whether it's a Disney consultant who has an experience model that they're trying to be able to do, or through a cruise ship circumstance and things of that nature that do exist, or somebody who has private airlines. And they want to be able to have that travel agent book that private airline for that high-end experience. But it's not, like the old days, I grew up in a world, you had the insurance company, the travel agent, sometimes in the same place. You don't have that anymore. The world's kind of evolved past that, but they've kind of so gone beyond that 10%. You're talking about 30% or more. These are very complicated negotiated structures on a transaction by transaction basis. But, how long they're able to exist, look what they're trying to do. They're trying to look at the bricks and get involved, but the execution model's not there.
Let's keep this next one pretty general and let everybody kind of weigh in on this. Just generally, why do you feel like real estate should be in a portfolio, specifically multifamily and hotels? And how does that fit in with the general investor's portfolio as far as, stocks, bonds, other types of real estate?
Okay, I'll start. So multifamily, there's cycles in between the real estate cycle for each asset class. What's hot, what's not, what's over, where there's an ability to find inefficiency. That's one thing that equities, stocks, bonds, and again, I'm not a financial advisor, I'm just telling you basic economics that I would tell my classes that I teach. But the concept is that market and money is made on the building of inefficiencies. And those inefficiencies move in geographies and within asset classes. So those geographies could be, okay, everyone's moving to Florida. There's a huge demand and a huge driver, which is exciting because of tax implications that have changed from a macroeconomic place. And that's important. That's great. So you want to make sure you're part of that. No matter what you're investing in, whatever piece, and I'll get down the layer. But each asset class, land is the first thing to go up and the first thing to go down, and everything else in between, hotels, multifamily, residential, and so on. And as those inefficiencies are removed, the yield spreads, the risk to reward ratio starts to shrink. So that's what you have to watch. So as you align those in your investment decisions to how you see what the equity markets are, is where you need to allocate. The second piece is why it belongs into a portfolios is because it's part of a inconsistent model that where you could buy a stock X and it could be up and down the next day. Real estate values have a tendency to be able to have longer term periods of spike, bust, and stabilization, but the bricks aren't running down the block. They're still there. So you make your money on the buy, not on the sell. That's a basic concept in regard to real estate, and how well you do it, that's who you choose to be able to have as your asset manager and overall advisor to be able to make those decisions. And I think that having an active management role like I do and your firm does in regard to you're not just throwing the keys at someone, I think that's a difference. And the strength of us as being, in our role of having 1 foot in the boardroom and 1 foot in the mud is not the norm. So hopefully I answered your question.
Yeah, absolutely. Anybody else want to weigh in on that?
Yeah, I I would say, just to echo the comment in terms of operations, real estate, obviously, everybody knows it who's here. It's a great way to have passive income. In terms of a diversification, I think that's become tougher over time as assets have become more and more correlated. So it's hard to say that real estate is going to avoid the next downturn when stocks and bonds go down. That being said, I think the operating element in real estate is an interesting area of differentiation and diversification. And what I mean by that is so much capital has gone into deals that if you're the 12th guy bidding on a hotel and you win, what did you really win at some point? And so you really have to find a way through the operation to be able to diversify that. So for what I'm doing with Dream America, yes, we use real estate in the business, but at the end of the day, it is an operating business, and it's as much a bridge financing business as just a pure investment in real estate. And our opportunity to derive value from the real estate comes from the work that we actually do with the tenants to get them into the ownership position. So there's a benefit for them, but there's clearly a benefit for our investors as well.
That's,
If I may add just a
Yep,
quick comment.
absolutely.
That's a little bit relatable to this. One of our founding visions with the tokenization of real estate is to make it more easily to be fractionalized. And what that leads to is more liquidity in the market. Whereas, as I mentioned earlier, in the traditional way of doing things, someone needs to come in with $1 million, $2 million, and be locked in, and you're limiting yourself to a potential investor pool. If you can have fractionalized real estate holdings where someone, the average orthodontist from Fairfield County that has an extra 100,000, 200,000 laying around that they want to invest, if that pool of investors can now be tapped into and create liquidity in the market, I feel that will help drive the value of real estate, because now you don't have this illiquidity risk and illiquidity premium almost that you would otherwise face. So from our perspective, we feel that tokenization will help drive the real estate market and accessibility of real estate investments.
that's great. And that certainly leads into my next question. I think you answered a lot of it, but I'll let everybody else weigh in too if they'd like. You know, with real estate, I think for the average investor, the barriers to entrance has been greater, which obviously you spoke about, but I'll give you all a chance to speak about that if you would like to.
About the barriers to entry in the marketplace.
Yeah, into real estate.
So I could tell from the, we've handled multi-assets over the years, but I'll speak about hotels because that's where 80% of our focus is these days, with a slight twist on some commercial assets. But the high barrier entry for the hospitality industry is because it's so high touch. It is really again, an operating business that involves real estate as what it's enveloped into. It involves understanding of accounting, and that's a business that pennies make nickels, make dollars. So the high barrier to entry in the selection process of assets is heavily weighted on the operator's ability and knowledge to be able to know what's happening in the market, what has happened in the market, and what's coming down the pike. Your supply that you're going to be competing with if you're buying an asset, what's coming online, a new product, if you're building an asset, where you anticipate that you're going to be in that market set. How are you going to market? How are you going to differentiate and sustain that? You have markets will move and you'll have things that'll happen cyclically, but you have to have that asset have a purpose. And I think that a hotel and a hospitality-driven asset adds a major layer of complication because it also feeds off of the things that are happening everywhere. What's happening residentially in the area? What's happening commercially? How is that area supporting it? And why that asset needs to be there. So it's a hotel asset that still has the touch points of what's happening, all the other things. If businesses are leaving and people need to stay there to be able to do business, and that changes in the environment, not to pick on Connecticut, but look at GE leaving and what it's done to Westport. It looks like more like an advertisement for Sotheby's. You drive down the block. So it's an interesting kind of concept to see all of these homes that are out there and these executives that were working for GE that have no place to go. How does that impact retail? How does that impact even the hotel business? It's important. And you just can't look at it blindly. So I don't think it's for the faint of heart. And I think it's for those that are seasoned over cycles and really understand how to roll up their sleeves and how to make those pennies make dollars.
Makes perfect sense. Anything from you on that, Chris?
Yeah, I mean, I guess the only thing I would say is you know, going back over a longer period of time, this started with REITs and the equitization of real estate, and now more recently coming into crowdfunding. There's a lot of crowdfunding platforms that are out there that open up access to real estate, which is something historically that was harder to invest in for an individual, certainly on an individual deal. What that, one of the question marks in my mind is, what does that do to the diversification benefit of real estate over time, and what does that do to the return? So yes, more capital comes into the space, but then the question is, does that press down the returns, and what does that look like going forward? So I think this point about the operation is a way to differentiate as opposed to just buying a static asset and owning it. I think it's going to be much harder to get a return on that, than it has been over the past decade.
Definitely.
Makes sense, makes sense. So let's take that up one level. So let's take it to the RA family office level where the bigger money starts to roll in. What's the outlook that you're seeing there from those guys as far as money into this environment?
I'll let you start that one. I've been starting.
Yeah, I mean, the family offices have been, as Michael said earlier about the family offices in Florida having a lot of wealth created through real estate. I think that's true for families generally nationwide. Certainly, there's stories of people who've made a lot of money in equities or in building up their companies, but there's probably far greater that have made that in real estate, and I think that trend continues. So we talk to a lot of family offices that are interested not only, in investing in existing assets, but also doing development themselves, and they still view it as a way to generate a lot of wealth. I think an important element in that we haven't really touched on here, but I'm sure everybody in the room knows, is also the tax side of this, which is you have the ability to generate this passive income, which because of depreciation may largely be shielded from federal income tax or state income tax if you're in a state with income tax. And that drives a lot of value over time when you multiply it, pound it.
So I just want to add one thing in regard to, you touched on a very key point. So for us, we kind of break down the world in kind of three things, right? You have like high net worth individuals, you've got family offices themselves, and you've got institutional kind of channels for capital. So what you've seen is a deconstruction to a certain extent of dependencies from an institutional side by the family offices and where they're getting things done, and they're getting their own chief investment officer who may be there for a period of time, not there later on. So there is assets and money that's rolling into assets that the sophistication may not be a consistent piece of the model. And we've seen some cases of that where, chief investment is over there, did a bunch of investments for 2 years, he's gone. And the family who's used to, buying art, at the latest and great Art Basel in Miami, and that's where their focus is, and that's fine. They've got their philanthropic needs, and now suddenly have this operational activity that they've never had to kind of deal with. So we've been sought out to be able to help in those circumstances. So I think that that's a unique transition where you're seeing certain things from that side. From the crowdfunding side, I can't comment. We don't get involved at all on that side. The institutional capital has money to be able to allocate, and I think that they've opened up their channels wider than just going to the same 9 guys to allocate. And I think that that's become more interesting in regard to those pieces and where money is trying to be able to find its way in and what's changed. I think that that's a big piece. You probably 5 years ago, 10 years ago, it was the same 9 guys. We all know them, Blackstone, BlackRock, Cerebus, et cetera, whoever else it could be, getting those channels opened up for them. And I think that there's emerging manager programs that are out there that are supporting smaller managers, women-owned, minorities, all these other great things that are really, truly fantastic that weren't as broadly available. and are being well promoted by states and by other institutions. And we're excited to see that, those channels open up.
Very good. Joseph had spoken a little bit about this earlier, but I want to open it up to everybody. What do you feel on geographic areas? Are there some that represent greater opportunities than others? Where are you focusing right now when it comes to that?
You got to say Florida here, right?
Absolutely, man. You'd probably be kicked off the panel if you didn't.
So we, ultimately, what we're doing is a financing activity. It's not a bet on real estate prices per se, but the Southeast, we specifically picked the Southeast because of the strong job market, which obviously is the underpinning for real estate. And it's created an interesting dynamic in our sector where if you look at an area, this isn't true in southern Florida, in Miami, the affordability there is less, but if you look up in the areas where we are active in Florida, which is Orlando and Jacksonville and Tampa, the median price homes are in the low to mid 200s, and the cost of building a new home, though, is above that. So there's a real squeeze on this median price home in terms of the value and the underlying support for it. Labor costs have gone up, material costs have gone up, and so you're not seeing new construction of single-family homes at that price point, and we think that makes a really attractive backdrop for investing in the space.
Philip, I assume from your standpoint, you're kind of everywhere. There's nothing that detracts you as far as geographic. Is that the case?
Well, again, since this is a Florida-based conference or Florida-sponsored conference to a degree, I am actually a living case study of escaping New York City, having been born and raised here, and then moving to Florida a few years ago. My case in point, the house I purchased about 5-6 years ago has appreciated 50% in the last 5-6 years. So I'd have to say Florida is a hot market. Globally, for us, we've actually been seeing quite a bit of inbound inquiries, questions, interest in markets in Southeast Asia. We're actually involved right now in a potential deal in Thailand for a condominium project that wants to tokenize, as well as one in the Philippines that wants to tokenize. But domestically, I would have to concur. I think you're going to see a flight of capital, a flight of residents, and people from the higher tax states to places like Florida, which Florida has my vote in general because I love it there. So.
And this is kind of off of the general geographic subject, but you mentioned Southeast Asia and tokenization. Do you get better reception outside of the U.S. in markets like Asia and Europe on the tokenization than you do here in the U.S.?
We do. There's right now the regulatory structures for tokenizations for cryptocurrencies, and that leads to a degree into tokenization. And a lot of people conflate cryptocurrencies with what was the whole ICO debacle about 1 or 2 years ago with tokens. To take a step back, really, cryptocurrencies are essentially currencies using cryptographic technology such as distributed ledger technology. Security tokens, tokenized assets, tokenized real estate don't really have much to do with cryptocurrencies other than they're using similar technology. And unfortunately, a lot of people shy away from the idea of tokenization or even talking about tokenization because they hear, oh, it's related to crypto and crypto is bad, so I'm going to run away. At the end of the day, the only thing you're seeing really is the underlying technology is the same, and it's proven technology. There's nothing mysterious about it. It's just the next evolution in software technology. But Asia and countries in Asia have almost all have taken a much stronger stance and lead in addressing and permitting the development and use of digital assets, crypto assets, tokens, mainly because they've really seen it as an opportunity to help to drive investments into their countries, and they've adjusted their regulatory schemes and the regulatory structures to make it an easily accessible market.
Just wanted to touch on this one really quickly since it's a hot topic out there right now. Opportunity zone funds. Do you all see an opportunity for your companies to go into opportunity zone funds? What's your overall outlook on that?
So the opportunity zone model slowed up a little bit because of IRS clarifications that we needed at the end of the year that was stalled out, and a lot of that clarification has come through. So we've been looking at some opportunity zone assets and opportunities, but you're battling time, for some of these projects and what it is and what the underlying fundamental basis of those edge of opportunities. You're talking about a census of 10 years ago, and once that census starts to change, 10 years ago, you didn't live in Florida, right? Look at the changes that have happened. And a small example, if you don't mind me saying, again, it's like your house moved 50% in value. And those edges of those fractional pieces of those markets that are now somewhat developed over the last cycle, there's opportunity zones and small fragments that exist in Manhattan. But you've got the ability in a fragment of time to be able to do something. But there's there are still some gray pieces. I'm not a tax expert, nor do I claim to be, but there is pieces that you need to be precautionary over. These are longer-term investments. Money is generally not 10-year money. It provides a great B option if you have the temperament to another alternate rather than just a straight 1031 exchange deal, if it's constructed and done correctly. But you have a window of time. I think they're fantastic. I think the sizes of the deals are all over the place. Some structures that were set up before that December, January kind of timeline. So it's proceed with caution. I think it's a great thing. I think people are finding a great way to be able to utilize it and finding great channels. I think that works better as a single asset structure than a fund because there's still issues about when money comes in and money goes out. How does that impact the person that's staying around 10 years and somebody liquidates sooner? It's not for the faint of heart. It's not for the advisor that's not well-versed in it. And for the developer to make sure that they're going to be able to adhere to the requirements as a functional structure and keep it within that opportunity zone methodology. So it's proceed, but proceed with caution.
Makes sense. Anybody else thoughts on that?
Say from my time on Wall Street working with companies and wealthy individuals who had low basis stock, I see a lot of people do a lot of things motivated by tax, which is not always a good motivation for an investment. So the starting point for the opportunity zone has to be, is it a good investment deal? Your point, do I see a good deal? Can I get into that? Then I think this offers a tremendous opportunity for not only the investor, but also for the communities to unlock money, which is basically dead money in the stock market. If you've got low basis stock, the tax code has incentivized you to never sell it because why would you pay capital gains tax when it goes through your estate, the basis steps up and you never pay that? So people who have tremendous wealth tied up in equities will not sell it. This now gives them an opportunity to sell it and redeploy that in a way that's going to positively impact the communities. And then it just boils down to, can they find the right deals to do that? So I'm bullish on it in the long term, but like anything new in the short term, there's going to be some winners, some losers, some frauds. So, you got to do your due diligence.
I just want to add one thing. I think that it's a 360 risk in that, right? The developers are not, some of them are not sophisticated enough to understand what they're committing to. So they could be taking on liability from a tax and structuring perspective that they're not just generally aware of. And then the second thing is the investor themselves and everybody in between. So that's why, just to add into that clarification of caution, it's really just not on the behalf of the investor. It's like up and down the line. So, and there's still variances in regard to things that are not clear in questions. the ability to have retained cash and what happens to that. You know, you got to deploy it. You can't hold on to that money and have a reserve. For a hotel, it's kind of weird. We have FF&E reserves. What does that mean? How is that treated? So there's an oddity if you're not capitalizing for it and how that's getting treated. Is it distribution? Is it what? So just again, a lot of minefields to walk through. But again, if you can get it done, bravo.
Good thoughts on that. The term right deal was mentioned quite a few times on that, and I think it's a good lead-in for the next question. We've had quite a run-up over the last 5+ years in the real estate market. So what do you see over the next 12 to 24 months, 3 to 5 years? Are there still good investment opportunities that are out there? Or are we kind of hitting a peak right now? I mean, what are your overall thoughts?
Yeah.
Crystal ball time.
Yeah, my crystal ball time. Yeah, I think there still are good opportunities out there. A lot of the inflation in asset prices the last decade has been driven by central bank policy. It looked for a moment there like we were going to get into a tighter environment, but now we're going the other direction in the U.S. and obviously globally it's even looser with, you know, zero interest rates. So
Negative now.
people have been forced into risk assets because they're getting zero or negative rates on, you know, so-called riskless government securities. I don't see that. I don't see that changing in the short term, and I think the underpinning for real estate is ultimately the economy. I think the economy in the U.S. is on a good path, and that's going to continue. Yeah, but it's still going to boil down to you got to find the right deals. It's not just, you can't just blindly throw. You could blindly throw money into real estate a decade ago, and it was hard to lose money. I think it is now easier to lose money. I saw one of these, just as an aside, one of these crowdfunding platforms. There's one called CrowdStreet, and they're constantly sending out. I got on the distribution list. You see these deals going out, and they're always boasting about the returns. And they sent one out the other day about a deal that over the last 4 years had lost 74% the equity value. So that was a ding. You know, their take on that was kind of you win some, you lose some. I sent them a pointed email on that. I was an investor in it, but I just think they did a poor job on the diligence on that deal, which is why their investors wound up in that situation. So yeah, I think more than ever, due diligence counts.
So from our side, we really operate best on the other side of the curve. I'm not really good at buying topside. I'm not good at being 12 guys chasing a deal because capital has to be put out. We're really good at fixing things, really good at being solution focused, really good at being value added. So for us, if it doesn't kind of meet that criteria, people know to call us because of those things, whether it is to stop the slide, stabilize, rebuild, reconstruct, finish construction, recapitalize, that's where we generally shine. So for us, if it doesn't meet those components, we're not really going after it. Though that market has gotten slimmer, we are already seeing stuff falling on the other side of the curve. But a good deal today is defined by basis. So there's the deal that we're doing right now in Dallas that we're completing negotiations on. Unbelievable location, fantastic. We're very good friends with the brand. We're renegotiating the franchise agreement. We're stepping in, but it was bought generationally. And you can't duplicate the location. Everything that's there, let's say the larger institutions surrounding, buy it up. High barrier to entry. Like it. That's good. That has something that's unique. That's a deal you run, not walk towards. But the stuff that you're getting, 3,000 of the 5,000 friends and family of Easthill and Newmark and all this other stuff. I mean, realistically, you know, someone's buying that at the end of the day, well, what are you buying? You know, I remember, if I could quote him for a second, when he was still the CEO of Vornado, Fascitelli was talking. And he was like, you know, yeah, we did a lot of deals. We won a lot of bids. It just means that we were willing to pay the highest price. That doesn't mean that you did a lot of good deals, right? It's only time will tell on that. So from our perspective, we're looking for that great basis. We're looking for that capability for us to be able to fix something or take advantage of a market dislocation. I just don't know how to execute and get excited about something that doesn't have an inefficiency. I'm driven by it. I'm able to find it, open it up, build it out, take advantage of it, and that's where we shine.
If I can add one comment, and I'll preface this by saying that from our perspective, we're a little bit different than the other gentlemen on the panel because we are indirectly involved in real estate because we are simply the software and technology side of things. We don't have any other broker dealing, investment side, nothing. We're just a technology play. But one thing which I'll mention is that we are optimistic in the real estate market, the global real estate market in general, simply because, again, it's a very illiquid, very difficult market for most investors to get into. And I'll harken back to the earlier comment and the question regarding family offices and investors. Basically, anybody here in this room, anybody on the street, from a partner here to the person driving an Uber, driving the bus, anybody can go and buy public equities. They can buy stocks of Apple, Google, Starbucks, right? It's much, much harder for the average person to get into real estate. And we're optimistic because we think that the changes in technology in real estate will help open the doors to new investment and new capital, and that will help drive the real estate market. So that's just our perspective from the technology side.
Sounds good. Thank you for that. As a follow-up to that, if we do, in the next few years, if we do see a recession, how do you think that affects the real estate market? I think we came off, the last recession obviously affected the real estate market extremely hard. How's it going to compare? How does this one look versus the last one? How does that affect you all?
I don't think you're going to have the same shock and awe. I think what you're going to do is have a slowdown to stabilization, and I think that you're going to see values flatten out, which will create efficiency. And it's going to be, I remember back in the 90s, there was a point, you go like this to Wall Street, and the point to the building was $125 a foot. Buy any one you want. Everyone was trying to get it for 90, 110, $100. Point to any building down there, $125 a foot, you could have bought it. And that's when the market flattens out. I think you're going to have something like that in regard to a slowdown, slower growth, as you're starting to see already globally. I think that that's what it's going to look like until there's a new driver within the vertical of industries, whether that vertical is transportation, whether that vertical is some other new technology, new tax structure, anything in that regard is going to be what's going to drive that next occurrence of a recuperated marketplace. But I don't think there's anything that I could smell. I saw, a lot of people saw what was going on in that 07 into that 08 world. I think there's a lot of protections that are in the banking system to be able to prevent that from occurring again. And I think that you're going to have something that's going to occur, but it's going to occur because of a change of flavor. It's not going to be because there's necessarily, you might have boom and bust issues in certain areas geographically, but I think that what's going to happen is it's going to be a shift in flavor. Oh, wow, and technology stocks are hard again. Oh, emerging markets. We heard emerging markets 10 years ago for 5 years straight. They all boomed and bust. No one's going and try to change, trade Argentinian dollars. And now you see that that's changed. Now people are looking at it, the real estate for the last definitely 5 to 7 years very strongly as far as their investment portfolio. So I think that's it's a different thing that's going to happen. I don't think you're going to have this earth crack and everyone's going to fall beneath it.
I agree with that in terms of the kind of flattening out scenario. In the space that we're playing in with median price homes, I mentioned earlier, you haven't seen new construction there. So when you see these stories about, slowdown in new home sales in certain markets, they are typically talking about higher priced homes that may be $300,000, $400,000, $500,000, which the builders obviously focused on because there's a better margin in that. The houses that are trading in the 200s, not to say that there's not downside, but they continue despite the fact that they may have gone from, since 2012 to now, 100 to 200, they're still trading below replacement cost. So will they go sideways if People have a hard time getting a job, of course, because rental income is supporting a lot of these properties. But I don't see the big kind of downdraft that we had before. That was a unique event.
So you see it as fairly stable and home ownership continuing to rise, supporting your product?
Yeah, I mean, affordability obviously is a constant issue for people trying to become homeowners. So is the prices going up quicker than wages certainly puts pressure on it. But I don't see a big move down in it, because at the end of the day, the ability to, it's clearly in a downturn, fewer people are going to be able to buy a house. But even if you go back to a period like 08, 09, rents didn't go down, because all of a sudden more people had to rent. The rents actually went up. And then if the rents are there, that supports investors being there. And, to your point, on Wall Street, it was 125, but everyone wanted it 90, 100. The same thing happened in the last downturn. For everybody I know who made money buying distressed properties, I know a bunch more guys that missed it by $10 a foot. And they're waiting for the next time. So I don't think it's going to be as severe of a downturn.
No, it'd be the appearance of the world is flat, but it's really round. It's just a matter of time until it cycles back. If you're in good markets, if you're in tertiary markets that are like dependent upon something specific like fracking or something in that regard, as a stopgap, you're going to have an issue. But, if you're in major top 20, 25 markets, the world's always round. It's just going to appear flat for a while. A lot of fear going towards the edge of the horizon where the sky and the earth meet. So.
Makes sense. I'll kind of leave this as a last question and parting comments for everybody before we go into Q&A. What types of real estate in each of your respective businesses do you feel are the best opportunity right now and will perform the best over the next few years?
For us, I'll say that we see sub 300 key hotels, really sweet spot of sub 200, and that 125 to 200. I love that size. You're able to fluctuate. You don't have to worry about what it feels like in being a 400-room hotel when you've only got 120 rooms that are being occupied, which impairs your experience for the ultimate guest. And that's my concern. That's my client day one. And then being, obviously those properties, enabling them at those sizes, you could still be a good citizen within the community of where your properties are, which is extremely important, and how you support those communities. And that includes not just the people that you work with on those assets, but what you can do to be able to contribute and be a good citizen there is changed by that ability to have that size. So for us, it's really where we see that opportunity is where we're really focusing and honing in on. You could do really great with a 110-room hotel on a consistent basis and know how to be able to control that inventory. 400 rooms, there's a point in the price break where it's costing you to be able to just fill it. And you want to stay away from that. Go par is the technical word.
So I lived in New Jersey for 15 years before moving back to Manhattan and then down to Florida. When I moved there, you could actually save money on income taxes by living in New Jersey relative to New York. It's now one of the highest tax states in the country. The house that'll cost you $500,000 in New Jersey with $15,000 of property tax, it's $250,000 in Jacksonville with $2,500 of property tax and no state income tax. So I'm very bullish on the kind of median price homes in markets, particularly Florida, where you don't have the state income tax and the business-friendly environment, which is bringing more jobs down there. Again, coming back to my background on Wall Street, the big banks used to put the back office in New Jersey to save money. You can't save any money in New Jersey anymore, but 10, 20 bucks a foot on the office space. It's not like you could pay people less. The cost of living is very high, whereas now you have one of the last things they were looking at before I left BNP, which was 2 years ago, which means they're probably still looking at it. This is the pace that banks go at, was whether they were going to move the back office, which is in Canada and New Jersey, to either Jacksonville or Phoenix. That's already happened at many other banks, and that conversation is going on everywhere because they know that even if they offer an employee a lower salary to relocate, they're going to have a much higher cost of living. So the bank and the shareholders can save money, and the employee can actually benefit from it as well. And I don't see that trend reversing. So I think the place to be in real estate is really going to be driven by what the value of the homes are now, what the taxes are in those states, and then what are the business policies in those states? So, got a lot of concern about the tri-state area, but Florida, I think, is well positioned to continue to benefit from this.
I'll add one quick note. We are optimistic in real estate that's been tokenized, so that's our vote. But we're a little bit biased in that. I will add one thing that some of the gentlemen mentioned about different neighborhoods and areas becoming more desirable, less desirable in terms of investments. One of the condos I had in Boston, in the Brighton neighborhood, if any of you know it, I wound up selling it because there was no parking there, and this was around 2009, 2010, and it was so miserable. It was getting so miserable to try to get anywhere with a car and to find and rent parking spots blocks away that I gave up and wound up moving to Seaport. Now, that neighborhood, if fast forward 5 years, if I still owned that property, I'd probably still be living there because now there's Uber. Now I can get ride sharing. So I would just have the caveat that to be cognizant of not being blindsided by unexpected events. 10 years ago when I sold the property, I never expected it would be a better property because of Uber. I just never imagined it. Now it's a more popular neighborhood because even without a car, anybody can get around. So.
Any other closing thoughts from you all before I open it up to question and answer? Sounds good. That being said, any questions from the audience? Okay, go ahead.
One, you had the pre-08 period, now you got the post-08 period. Real estate is an illiquid asset, so as an investor, that has to be a consideration. How do you address the beta portion of real estate and structuring a portfolio in that you're able to take advantage or address risks like a beta portion example, changes in tax laws? What do you see occurring or potentially occurring going forward here, and how would you address your real estate portfolio in that regard if, let's say, you're a family office?
Is that question?
It's addressed to the panel.
I'll have to pass on the question simply because we as a company are not involved in real estate investments, but.
Yeah, I mean, I'll say, yes, there's clearly a beta portion of real estate as there are in stocks, as there are in many asset classes. There's no long-short real estate. I mean, the short on real estate is, don't be in New Jersey, be in Florida, because of some of these macro trends that are in place. And obviously, there's the technology element as well. I mean, you talked about Uber and that changing the desirability of the neighborhood. I mean, you see that in Manhattan, like the Lower East Side. Anywhere that had tough access to a subway is now in a different situation with Uber. We've obviously seen it with retail as well, where, why bother to go to the retail store if I can get everything on Amazon? These types of things, and I'm sure there's many things that we're not even thinking about now that are going to continue to be an issue for real estate from a technology standpoint. That being said, I think in any well-diversified portfolio, depending upon the investor's risk tolerance and whether they actually need that, the underlying assets to live off of at some point, or if it truly is money that they're just leaving in there for the long term, real estate's going to continue to be an important part of that illiquids bucket. Then each investor, each family office is going to decide, do I like to do that directly? Do I like to do it through a fund? I know we've got a panel on that later. How do I feel about hedge funds or private equity? Frankly, I still feel like real estate offers a better value proposition, just based on my own personal experience in investing in private equity and hedge funds than many of those other illiquid alternatives.
Hello. Hi, my name is Henry Awanati with Old Hill Partners. The question is actually for Philip, and it's several questions in one, if you don't mind. A second. So I'm interested, what is your fee model as a firm and generally in the industry? And if you can speak to regulation of that space, both in the U.S. and internationally, and also market making and providing liquidity for these tokens.
Sure, sure.
Thank you so much.
I'll try to be brief because that, and I would love to talk to you and anyone else here in more depth after the panel, without getting too off track. So the pricing model, Token IQ has a flat pricing model where, and this is sort of a moving target, but generally, and depending on the circumstances, we will charge a flat $75,000 for a firm, for an issuer who is looking to tokenize, whether it's a private equity tokenization, a fixed income note tokenization, or a real estate tokenization. Generally, that's $75,000. We usually take around $25,000 to $30,000 cash, the remainder in tokens. And then on the back end, the ongoing revenue stream for that is we charge $5 per wallet, so basically $5 per account per year to maintain the technology, to essentially maintain the AML, and anti-money laundering, KYC, know your client, maintenance on that, to maintain essentially the record keeping, the 1065, the reporting, et cetera. So that's in the short version of the pricing model. Our competitors, most of them have a little bit different pricing model where they charge a percentage on the raise, on the cap raise that the issuer is doing. We don't do percentage, we just do a flat fee. The second question was, I believe, the regulatory aspects. Frankly, the U.S., the CFTC, the SEC has been somewhat slow and a little bit behind the eight ball, coming out with substantial and definitive regulatory statements in regards to tokenized assets, to cryptocurrency. There was an ABA, American Bar Association, paper which was released in, I believe, March or April or so, which provides a very good overview of the U.S.'s regulatory schema versus foreign countries' regulations. Some of the more, really quickly, some of the more promising markets from a regulatory perspective we've seen, places like Malta, which is becoming a hotspot for tokenized assets, Singapore, Japan to a degree, and again, as I mentioned earlier, so most of Southeast Asia, most of the countries in Southeast Asia and Asia are focusing more heavily. Last question on market making. Again, I hate to keep harping on this, but regarding real estate market making or the tokenization of real estate, but also tokenization of other assets. And one of the things that we've been looking at doing is tokenizing fine art, tokenizing collectible luxury cars. And that is a perfect application of technology to an otherwise very illiquid asset. The example I usually give is anybody on their Apple Watch or their iPhone right now can look up the price of Google and what's trading at 30 seconds ago, right? So everyone knows what the price of Google is at any given time. It's very, very difficult to price something like a Picasso or a Van Gogh. You'd have to look at the recent sales, recent auctions of it, and if it's only traded hands maybe 2-3 times in the last 20, 30 years, it's so illiquid that it's very difficult to price. One of our goals, again, in the fractionalization of assets, including real estate, but fractionalization of fine art, collectible cars, et cetera, is to add liquidity to the market. And when you have liquidity, you have better pricing, better insight into pricing. So instead of saying, well, let's look at the last 2-3 times that piece of art traded hands, now our vision, our long-term vision is to say, well, how much is this Van Gogh worth? And you can say, oh, let me just pull it up on my phone, and you'll have actual tokens and shares of that particular piece of art that you can buy. If you really like that painting, you can invest in it, or if you don't like it, you can short it. And that's our ultimate goal to the market making aspect of the technology. I hope that answers your question. If not, then I'm happy to discuss further offsite.
Should I go next? I have a question in the back. Putting multifamily in the kind of more global political context of regulation, we saw what happened to the New York market, for example, when, you know, the current administration wants to do everything it can to kind of suppress the ability of landlords to raise rents. Do we have any fear in major urban areas in particular about on a longer horizon, maybe a 5 or 10 year, that we're going in a direction where if I'm a longer term investor in multifamily, I have some concerns about whether, for example, in the current cap rate environment, that I'm going to be able to get the kind of returns, or do we see a government stepping in more and more to regulate rents to provide with lower income housing out of what is currently a market industry?
I think this is a broad statement, but for me, I would say you just can't underwrite a tsunami, right? If something's going to happen, it's going to happen. We're in the business of moving forward. If you're a builder, you're going to build. If you're a hotelier like we are, we're going to run and operate hotels to the best of efficiency and deal with things as they happen. You just can't arc that far ahead to start. You obviously are aware of fundamental occurrences and potentials that can happen from an administrative side in certain areas and locations that you're involved and you're investing in. But you just can't underwrite, you know, it's like you won't get out of bed in the morning, right, for certain people. But, you know, the idea is that the idea is you just can't underwrite a tsunami. If it's going to happen, it's just going to happen. You have to be prepared. You have to look at it. And you as an investor, and your own responsibility is where you're going to be able to see whether this is something that you're concerned about. And if you feel it's closer to a reality than we think that it is, then you shouldn't do the deal. It's really as simple as that. I think that, you know, the administrative changes and global issues are too far varied for me to be able to start to look back, and too vast. I could deal with today, now, and try to be able to look 3 to 5 years ahead based upon the fundamentals that touch what I do for a living. So I'm not running for office. Maybe one of my sons might one day. But it won't be this Joseph DiMatteo, so if that helps you at all.
I'll add one comment, and this is a little bit outside my purview, but perhaps it's beneficial to have sort of an outsider perspective. To your question, I think the continual use of rent control and government intervention in a lot of the major cities, urban areas, especially in the Northeast. This moves beyond rent control, but even taxation, as was discussed earlier. You're going to see perhaps that giving a boost to the flight of people, flight of businesses to states that take more of a hands-off approach to the regulation of real estate and pricing, such as Florida. You know, I lean towards being more of a libertarian at heart. And I have to say, part of the reason I got out of the Northeast was because it was just an overwhelming burden of regulation, and everything was just a hassle. And starting my company a few years ago in Florida was a pleasure. It took a day or two to file for an LLC, whereas in the Northeast, where I was in Boston, I'd probably still be dealing with filing incorporating. So that's my perspective from sort of an outside view.
Yeah, I would say, you know, kind of two parts on that. One of your comment was on cap rate. Obviously, the cap rates on multifamily have cranked down a lot the last decade, which hasn't happened as much in some other things like office for a variety of reasons. So I don't see a way out of that, because part of that was driven by the central bank policy. So that risk exists broadly. From a regulatory standpoint, it's an excellent question on due diligence. I don't know what the future holds, but certainly one of the elements that I looked at in picking markets for Dream America was, I don't want to throw anybody out of their house, but the basic question is, if we have to evict someone, is it a straightforward process? And in the markets that we operate in, it is a straightforward process. If tenants don't pay rent, it is not difficult to get them out. That is certainly not the case in the city that we're sitting in right now, but it is in the markets that we're operating in.